Hey guys, welcome to another video where I will teach you about risk management in forex trading. So like any other business, trading also has profit and losses. And making profit always sounds exciting because it excites everyone. You want to make profit, that's the end goal. But no one actually likes to hear about losing. No one likes to be told about losses. But it's important to consider it because it's very significant part of trading. Now you might know this or maybe you don't know, but every other time you place a trade in the forex market, anytime you execute a trading position, there are only two possibilities. And the first one is that the trade will go your way and you will make profit. The other possibility is that the trade can go against your way and you will lose. Yeah. So the important thing to note is you should never fear losing. Yeah. Don't fear losing so much in trading. Don't fear hitting stop loss. Because once you have that fear of hitting stop loss every other time, it means that it will even limit you from taking the trades because you cannot execute a trading position when you are in fear of losing. But the moment you are ready to accept the loss in forex, then you won't have any problem opening a trading position. So instead of actually fearing losses in forex, what you need to do is you need to learn how to manage them. Learn how to manage the losses, manage the risk which is inevitable instead of trying to run away from them. So that's exactly where risk management comes in. So under risk management, you're going to look at how you're supposed to use your stop loss. Then another commonly asked question is how much should you risk per trade? How much of your capital should you be risking for every trade? And finally, you're going to look at risk to reward, which is basically the ratio of your profit target as compared to what you are risking for every trade. So let's get straight into it. The first thing is using a stop loss. So stop loss is just simply a risk management measure that, allows you to allocate a specified amount of risk for every trade. For instance, I want to take a buy position at this point. I can simply come and place my stop loss at this price point below. Because if I'm buying here, I'm simply trying to anticipate that price will move upwards here. So in case price comes down and it goes trades below my stop loss zone, then I will accept that loss and I will close my trade at negative. So the advantage of using stop loss is that it protects your trade in case of any bad market conditions. So the forex market is usually very unpredictable sometimes, and however much you might think you're the best trader, sometimes you might have some unforeseen crazy volatility in the market, which might cause price to move rapidly. Yeah. And in case of such a thing in the market, you want your trade to always be protected. So in case we have a very instant, rapid movement in the market, sometimes it can happen even within few minutes or few seconds. So you might be here thinking that your trade is safe. You come and the next thing you know that price is trading all the way here, and now you are seeing a very, very big loss which can wipe away, which can wipe out all of your account. So to avoid being in such a situation, you always want to have a stop loss. So if I'm buying at this point, I can put my stop loss here. And as you can see, my stop loss is 38.4 pips. So I'm simply acknowledging the fact that I am ready to lose 38.4 pips on this trade in the case that it does not go my way. So never trade without a stop loss. Regardless of what you hear some people say, um, trading without a stop loss is the same thing as driving a car without a brakes. You might argue and say that you're the best driver, you drive slowly, you're very careful, so you can drive without brakes. But the thing is, you're not the only driver on the road. You might be very careful, but then you meet an oncoming driver who is careless and reckless. So you can't you can't drive a car without brakes. Neither can you trade without a stop loss if you want to be safe in the long run. And the size of your stop loss will now depend on your trading system, and that can be a lesson for another day. So we move to the next thing. How much should you risk per trade? And here is my answer. From trading, over a long period of time, now 5 years in the market, I'll tell you the best risk management practice that you want to use is risking between 0.5% to 2% risk per trade setup. So the maximum I'll advise you to risk is 2%. If possible, you can risk anywhere in between. So if you are trading your own funded account, meaning you have funded your own account and it's basically your trading capital, you can risk up to 2%. I think that's quite reasonable because in this case the account is yours. So that means you have no limit on the drawdown. So in case you're risking 2%, it means it will take you 50 losing trades in a row for you to lose 100% of your account, which practically is not very, very possible for you to lose 50 trades in a row. So that's good risk management, yeah. But if you're doing a prop firm now, prop firms, they have several limitations. For instance, most prop firms allow you to lose a maximum of 10%, sometimes 12%. But let's go with the 10%, which is common. You're allowed to lose 10% maximum. So if you start doing 2% risk here, um, only 5 trades will wipe you out. But if you do 1.5% risk, it increases, the number of trades that you can do. Myself, whenever I'm doing prop firms, I prefer 1% risk, not even 1.5. Because at 1% risk, it means it will take me 10 losing trades in a row, a 10 losing streak for me to blow my account, which is practically not possible. And I'm saying it's not possible because I already have a system that I've been using and I've backtested, so I know how my system works. And there is nowhere in my system where I have 10 losing streaks. Now, just by learning this part alone, you realize one thing. It is not easy to blow a Forex account. Some people say it's very easy to blow a Forex account, but anyone who speaks such language simply means they don't understand risk management, or if they do, then they do not practice good risk management in their trading account. Because from this information here, you realize, assuming you even do 2% risk um, per trade setup, it will take you 50 losing trades in a row to blow an account. If you look at people who blow accounts, they don't even have 10 losing streaks. They only lose 2 to 3 trades and you blow an account. That speaks volumes. It simply means you don't use proper risk management and you're trying to gamble. If you try to gamble, you will try to be risking 20% on a trade and gambling that if it goes your way, you'll be able to make maybe 50, 100% return within one trade. But now that's gambling and it is very, very, it is not sustainable in the long run. Yeah. But if you want to trade professionally, consistently be able to trade prop firms, which have the limit of 10% overall drawdown and sometimes 5% daily drawdown, you want to have a risk management plan that is very, very reasonable and practical, such that you can be able to risk less, but still be able to, have reasonable gains. So if you've ever blown your Forex account, myself, of course, I've blown accounts long time ago when I started, but after getting this knowledge, I don't remember the last time that I blew a Forex account. So if you're still actively blowing accounts at this time and you've been in the Forex industry for a while, I hope after watching this video and learning this risk management, you won't be blowing accounts anymore because it's not that easy for you to have 50 losing trades in a row. Yeah. The next thing is risk to reward ratio, commonly referred to as RR. Yeah. So it is simply the ratio of what you are risking per trade as compared to what you are looking to gain in terms of profit. Yeah. So what you are risking as compared to what you are looking to gain. In other words, the risk to reward. So what you are risking as compared to the reward, what are you looking to gain? So pay attention because it is like one of the most important things on risk management. In fact, if you understand this, it will solve a lot of problems for you as a trader. For instance, if I am risking, let's say, 40 pips on one trade, how much am I looking to gain? Am I risking 40 so that I can gain another 40? Or am I risking 40 to gain 50, 60, 70, 80? Am I risking 40 pips to gain 200 pips? So that is what is called the risk to reward ratio. The idea here is that you want to be gaining a significantly bigger portion of profit as compared to what you are risking. If I'm risking 1% a trade, or if you are risking 1% a trade, you want to be gaining at least 2, 3 times, 4 times, or even 5 times what you're risking. And the advantage here is that your winning trades will become very big. So whenever you're winning, you'll be winning very big trades in terms of very big reward, such that losing will hardly affect your growth. Maybe if I show some practical examples, you'll understand clearly. Now let's say I'm getting into a buy position at this point. Let's say I get into a buy position at this point here, and my stop loss. So I'm going to use my normal stop loss because I'm just giving you an example. So normally on my trades, I use roughly 40 to 45 pips stop loss here. So let's use 40 pips as the stop loss. So if my stop loss is 40 pips and I target another 40 pips, so I'll be risking 40 to gain 40, and my risk to reward ratio will be 1:1. Yeah. If I decide to target, let's say 80 pips, 80 pips will be 2 times my stop loss. So my risk to reward ratio, as you can see it's written here, is a ratio of 2, or rather 1:2. Simply meaning I'm risking 40 to gain 80, which is 2 times my risk. So it continues just like that. If I'm risking 40, let's say to make 100 pips, my risk to reward is roughly 2.5, or 1:2.5. That is the risk to reward, but the reward here is 2.5. If let's say we do 100 and let's say we do 200 pips, 200 pips simply means my risk to reward ratio becomes 1:5. So I'm looking to gain 5 times my risk. So back to explaining the same idea, the greater your risk to reward ratio, the better off you are as a trader in terms of becoming profitable in the long run. So what is a good risk to reward ratio? Should you use a risk reward of 1:1? Let's say you are risking 40 pips for you to gain 40 pips. That becomes 1:1. Is it a good risk to reward ratio? It's not the best, because yes, you are risking 40 pips, and maybe if it goes to your, if it goes into your direction, you're going to gain 40 pips. But this is not the best way to gain. If you want to have a good risk to reward ratio system, I advise a minimum of 1:2. That is the minimum. But if you have even a better system, myself, I use a risk reward of 1:3 on most of my trades. Then I have a few specific pairs like GBP, Australian dollar, which I always do a risk reward of up to 1:4, 1:5. So let's go the example of 1:3. So you're risking 40 pips to gain roughly 120 pips. So I want to use an example where we have a strategy that has a 50% win rate. So if you think of a 50% win rate, it doesn't sound very good, yeah? If someone tells you they have a 50% win rate, you're most likely to think that their strategy is not the best, because everyone tells you they want an 80% win rate, 70% win rate. Some even want 90% win rate. It's possible to find, but not very easy. So instead of trying to look for something that is you'll spend years trying to get a 90% win rate. You don't necessarily need a 90% win rate. So I want to give an example using a 50% win rate right now. So I've created a table here. As you can see, let's assume we have a $10,000 trading account here. We are risking 1% per trade. That means every trade we are risking $100, right? In case we hit stop loss, how much are we losing? We're losing $100. Then our risk to reward ratio is 1:3. Meaning every time we hit profit, we'll be winning 3 times our risk. So these are 10 trades. These are 10 trades, number 1 to 10. And this is a 50% win rate. So we have 1, 2, 3, 4, 5 winning trades, and the rest are losing trades. So it's even. So this is a 50% win rate strategy. This is just an assumption, guys. Yeah. So 5 wins, 5 losses. Whenever we win, how much are we making? We are making $300 because we are making 3 times our risk. So $300 is 3%, which is 3 times of 1%. I hope you're getting the concept. Anytime we hit a loss, we are losing only 1%, which is $100. So now using the very same data, I want you to realize one thing. Every winning trade, out of the 5 winning trades, each making $300, we make a profit of 1,500, yeah? Then the 5 losing trades are only losing $100. So we are making a loss of $500 for the 5 losing trades. And as you can see, our result is a net profit of $1,000. So these are only 10 trades, yes? out of the 10 trades, we have a 50% win rate strategy, not even a 60%, not 70%, 50% win rate, and we've still been able to make 10% gain. How long will it take me to get 10 trades? Because normally I do 3 to 5 trades in a week. So 10 trades will take me anywhere between 2 to 3 weeks, and you've already hit 10% of the account. So this is the power of using a good risk to reward ratio. Keep in mind, this is just my example where I use 1:3 risk to reward. Assuming you're someone who risks 2% per trade, your figures will even double. You'll do roughly 20% gain within this number of trades. Yeah. And by the way, just a disclaimer, my win rate actually is not even 50%. The strategy that I use, my win rate is roughly 68 to 70% win rate. So that means the gains are even higher. Now, one of the biggest advantage of using a good risk to reward ratio is this. One trade makes one trade makes 3 times what I'm losing on one trade. So that simply means even if I did one, two, three losing trades in a row, assuming I did 3 losses in a row, then I found just one profit trade, I recover all my losses within one trade. Now, this is not the same when you're doing a poor risk to reward ratio like 1:1. So always try to make sure that your risk to reward ratio system is quite big if you want to have great returns. Now, this is where it gets interesting, guys. Yeah, let's assume we now had a 30% win rate strategy. Yeah, sounds very terrible. If someone tells you their strategy does only 30% win rate, you might not want to associate yourself with them. I know, typically. So, 30% win rate means you are doing 7 losses and you're only winning 3. Now, let's use the same risk reward of 1:3. Yeah. So, if we do 7 losses, that is 7 times $100. So, how much do we lose? We lose $700. Now, if we make profit, we're going to make $300 for only 3 trades. So how much do we make? We make $900. The difference between 900 and 700, what is it? Remember, 900 is the profit trade, 300 times 3. 700 is the losing trades, which is 100 losses. I mean, $100 for 7 losses. So the difference between 900 and 700 is still positive $200, which is roughly 2%. Imagine having a 30% win rate, but you're still making 2%. That is, it sounds like magic, but it's all the power of having a good risk to reward ratio. So now, long story short, the greater your risk to reward ratio, the higher chances of you becoming, very profitable in the long run. So after watching this video, I want you to change how you view your trading. Don't think that becoming successful has got much to do with having a 90% win rate or having an 80-85% strategy the way most people try to teach you. You can have a 90% strategy and you have a risk reward ratio of 1:1. That is quite terrible, to be honest. You'd rather have even a 40-50% win rate and have a good risk to reward ratio. So that is the power of risk to reward. So what you need to do now after watching this, after learning this, try to evaluate your trading system and factor in risk management. So first of all, you've learned that risk management is not all about stop loss alone. Stop loss is part of it. But apart from stop loss, we also have the the percentage you should risk for every trade, which will also lead you to calculating the lot size, depending on the amount you want to risk per trade. For instance, if I want to risk $100 per trade, I will calculate and get a lot size that will be risking $100 only whenever I'm using my stop loss of 40 or 45 pips. Then finally, we've also learned about risk to reward, which is still part of risk management. So by the time this concept actually, settles very well in your head, you'll realize that even your trading psychology will improve. Do you know why? Because you will stop fearing losses. For instance, with my strategy, if I'm doing 60% win rate, and I know one winning trade is enough to cover one winning trade is enough to cover 3 losses in a row, it even boosts my confidence as a trader. That means I'm not so afraid of losses. So if you see me taking a trade on Monday, I hit stop loss. Tuesday, I hit stop loss. Wednesday, I hit stop loss. That's just an example. It rarely happens. But in case it happens that way, I'm not so scared because I know one good profitable trade will be enough to cover all the 3 losses in a row, and another trade will even take me up 3%. That is the kind of confidence that you get when you have such a system that has a good risk to reward ratio, and eventually boosts your confidence and improves your trading psychology as a trader. Yeah, and I think we are done with the video. That's it for the lesson. I believe if you take in whatever afterward and you apply correctly, then you will take your trading to the next level.